$755,000 saved for retirement. 55 years old, 5 years until you want to walk out. And by every metric the financial planning industry has handed you, you're right on the edge of making it work. The simulation says 85%, green light. But there is a version of this plan where you retire at 60, pay almost zero federal income tax for the next 5 years, and qualify for heavily subsidized health insurance until Medicare takes over. And there is another version, the one most people accidentally execute, where you retire at the same date, pull from the wrong account, blow past a specific income threshold, and quietly spend somewhere between $60,000 and $80,000 more than necessary before you turn 65. Same savings, same retirement date, two completely different financial realities. The only thing separating them is a decision you make in the next few years while you're still working. This is not about whether you can retire. You can. This is about how you retire. And the how changes everything. Here's the thesis. Most retirement planning conversations are built around one question. Do you have enough? That question matters, but it's the wrong question to optimize for in your final 5 years before exit. The question you should be obsessing over is this: where is the money sitting? Because where it sits determines what it costs you to pull it out. And the cost of pulling it out through taxes, through health insurance premiums, through ACA subsidy cliffs is where the plan either works beautifully or quietly bleeds out. I spent more than 10 years running a business surrounded by accountants and tax attorneys who showed me how this actually functions. The financial industry largely ignores it because your 401k provider doesn't get paid to optimize your ACA subsidy threshold. They get paid to manage assets. Those are different jobs. Here is the central concept I want you to hold for the rest of this video. Think of a funnel. Wide at the top, narrow at the bottom. For 30 years, most of us have been pouring everything into the same funnel, the tax-deferred funnel. Pre-tax dollars flow into the 401k. They compound, and sometime in retirement, you tip the funnel over and the money flows out. Simple. The problem is that everything inside a funnel comes out through one pipe. And between 60 and 65, that single pipe is controlled by two systems simultaneously, the IRS and the ACA marketplace. Pour too much through that pipe in any given year, and both of them reach in and take a cut. The strategy in this video is about building a second pipe, a parallel route, one that both systems largely ignore. The beautiful part is that building that second pipe requires doing less of what you've been trained to do, not more. Less 401k, more brokerage, different sequencing when you retire. That's the whole thing. Let me introduce a character, Marcus. Not me. I have my own situation, multiple hundreds of thousands invested, skin in the game, not theory, but I know a guy named Marcus who retired at 60 in 2024. He'd been maxing his 401k for 2 decades, $900,000 saved, 93% of it in pre-tax accounts. He walked out of his career proud, and by the numbers, he should have been fine. 3 months later, he went to set up his health insurance on the ACA marketplace and discovered something nobody had modeled for him, because he needed to pull $55,000 per year from his traditional IRA to cover expenses. His modified adjusted gross income was going to hover dangerously close to the income cliff that determines subsidy eligibility. Keep that in the back of your mind. Marcus becomes important again at the end of this video. Now, here is the thing that changed in 2026 that makes this conversation more urgent than it's ever been. From 2021 through 2025, the ACA's enhanced premium tax credits had expanded subsidies and made marketplace plans affordable for a large population of enrollees. Those enhanced credits are gone as of January 1st, 2026. For 2026, the pre-2021 rules are once again in place. What that means in practice is brutal, because the 400% of federal poverty level threshold is a hard cutoff for the premium tax credit. Even $1 of income beyond that amount can result in thousands of dollars of additional premiums. For a single filer in 2026, subsidies phase out entirely at 400% of the federal poverty level, which equals $62,600 for an individual. $1 over. Zero subsidy. Immediately. Let me show you what that actually costs on the wrong side of that line. The estimated average monthly benchmark premiums for ACA plans escalate to $1,072 at age 62, $1,101.80 by age 63, and top out at $1,120 for those ages 64 and 65. But those figures assume you're still getting some subsidy. If you blow past the cliff entirely, by age 64, the full price cost of health insurance can reach an average of $1,766 per month in 2026. That is $21,192 per year in premiums alone, before you've seen a single doctor. Now, there's a version of this, the subsidized version, where subsidies can mean the difference between a $400 monthly premium and a $0 to $40 monthly plan. The difference between those two outcomes for an early retiree between 60 and 65 can be tens of thousands of dollars. And the entire thing hinges on a single number: your modified adjusted gross income. Stay with me for the next section, because this is where the plan actually gets built. But first, I want to show you why the problem is even worse than it looks on the surface. You think the problem is your tax rate, but actually the problem is your MAGI. People confuse these constantly, and the confusion costs money. Your effective tax rate in early retirement might be very low, and your actual federal income tax bill might be small. But if your gross distributions from tax-deferred accounts are high, your modified adjusted gross income climbs regardless. The IRS taxes you on what you realize. The ACA prices your insurance based on your MAGI. They're different calculations running simultaneously, and both of them watch the same number go up when you pull from the traditional IRA. This is why having nearly all your assets in one tax-deferred funnel creates a structural problem that has nothing to do with whether you saved enough. Here's a stark data point. According to Vanguard's How America Saves 2025 report, the average 401k balance for workers aged 55 to 64 is $271,320, with a median of $95,642. If you're sitting at $755,000, you are significantly above average. You are not in accumulation trouble. You are in sequencing trouble. And sequencing trouble is solved by engineering, not by saving harder. Pattern interrupt. More than half of all workers, 58%, retire earlier than they planned, according to research from the Transamerica Center for Retirement Studies, usually due to unforeseen circumstances. The median retirement age in the United States is 62, with nearly 6 in 10 retirees stepping back from the workforce earlier than they had planned. You're planning for 60. You're already building in buffer. But if you're in the majority and something happens at 57, 58, 59, a health issue, a restructuring, a burnout, and you exit earlier than planned, the account structure you've built over the next few years either protects you or exposes you. The brokerage account is not secondary. It's your insurance against the unexpected timeline. Now let me build the actual plan with numbers. Take someone like Jamie, 55 years old, single, lives in Texas, $755,000 in total retirement savings, most of it tax deferred, with a smaller brokerage account. She earns $130,000 a year. She's maxing her 401k at the full catch-up eligible rate. Participants in most 401k plans who are 50 and older can generally contribute up to $32,500 each year, starting in 2026. She has a $60,000 rollover IRA from a previous job. She owns a home with a $1,000 monthly mortgage. She wants to spend about $4,000 per month in retirement. She expects Social Security of roughly $3,100 per month at 67. She currently pays about $7,000 per year for health insurance premiums. Can she retire at 60? Yes. The Monte Carlo simulation runs at 85%. That's a green light. Now comes the actual question. How does she retire? Under the standard plan max, the 401k until 60, then in retirement spend down cash and brokerage first. Here's what actually happens. Jamie runs out of non-tax deferred money roughly 18 months into retirement. By mid-2032, her only source of income is the traditional IRA and 401k. And to cover about $50,000 per year in expenses, she has to pull roughly $90,000 from the IRA once you account for the tax withholding she needs. Her MAGI that year, $90,000. She blows past the $62,600 ACA threshold. Subsidies gone. Healthcare premium, significantly elevated. Tax bill, meaningful. She's now paying roughly $9,500 in federal income tax and elevated insurance premiums simultaneously. The funnel is working exactly as designed, which is the problem. Now here is the alternative. 3 moves. That's all this is. Move 1, reduce the 401k contribution to only the employer match. 4% in, 4% matched. Call it roughly $10,400 annually. Everything above that threshold, roughly $22,000 per year, redirects into a taxable brokerage account. Yes, she pays more income tax today. At her income level, that costs her about $6,300 more in federal income tax per year while she's working. Real cost. I'm not minimizing it. But over 5 years, she builds approximately $250,000 in brokerage assets, instead of the near nothing she'd have otherwise. That $250,000 is her freedom account. It generates long-term capital gains, not ordinary income. And it's not a 401k, so it doesn't route through the funnel. Move 2. During the first 5 years of retirement, pull exactly $16,000 per year from the traditional IRA. Why $16,000? Because for single taxpayers, the standard deduction for tax year 2026 is $16,100. That $16,000 distribution is essentially covered by the standard deduction. Tax owed on it, nearly zero. She's draining the tax-deferred funnel at a rate the IRS barely touches. Move 3, cover the remaining income need from the brokerage account, long-term capital gains from investments held over a year. For 2026, single filers can earn up to $49,450 in taxable income and still pay 0% for long-term capital gains. She's well within that bracket. Her total modified adjusted gross income, roughly $37,000. Federal income tax, around $330 for the year. ACA subsidy eligibility, fully intact. Health insurance premiums, approximately what she's paying now while employed. Let me repeat that because it's worth pausing on. Same person, same retirement date, same savings, $330 in federal income tax in the first full year of retirement. ACA subsidies fully intact. This is not a loophole. This is the tax code doing exactly what it's designed to do. Traditional 401k and IRA contributions reduce your MAGI dollar for dollar, but in reverse distributions from those accounts add to your MAGI. If your income is close to the 400% federal poverty level cliff, how you structure your retirement distributions is the difference between full subsidy and zero subsidy. She holds this structure for years. 2032, same result. 2033, same result. 2034, she pulls a bit more from the IRA as the brokerage winds down, but total MAGI stays under $40,000. 2035, final year of bridging. 2036, she turns 65. Medicare begins. The ACA calculation no longer matters. Total outcome difference between the two strategies. Roughly $70,000 in combined tax and healthcare savings over those 5 years. The probability of retirement success drops by 1 percentage point. From 85 to 84, 1 percentage point for $70,000. That is the price of the wrong funnel. And that number doesn't even account for what happens if she cuts her spending by just $500 per month starting now. That single behavioral adjustment, going from $4,000 to $3,500 per month in current spending, saving $6,000 more per year, increases her retirement probability back to the original level and potentially lets her move retirement up by a year. The leverage in the 5-year window before exit is enormous in ways the accumulation math simply doesn't capture. Here's the part I'd be doing you a disservice not to mention. Knowing this strategy and having a plan built around it are two different things. I had this data for years before I had a structure that made the decisions automatic. I built a digital book called The Exit Code, 8 chapters of pure retirement research, no filler, specifically designed to solve the gap between understanding the numbers and building an executable framework. For this specific situation, the book covers what I call the $14,000 invisible bill, the insurance gap that quietly destroys pre-Medicare retirees. including the exact MAGI thresholds to engineer around before the ACA Cliff eliminates your subsidies entirely. It also covers the dynamic withdrawal method, because the rigid 4% rule was designed for 65-year-old retirees with 30-year horizons, not for 55-year-olds with potentially 40-year horizons. Morningstar's 2025 research found that retirees who experienced poor returns in the first 5 years and did not adjust their spending were far more likely to run out of money, and that is sequence of returns risk in action, the single biggest threat to any retirement withdrawal plan. The book builds in flexibility before you need it, not after the market has already hit you. You can get it through the link in the description for less than 1 hour with a mediocre financial advisor. Now, back to the math, because there's a dimension of this I haven't addressed yet, and it changes the psychological frame entirely. Let me give you the numbered framework 3 levels of the retirement income problem that most planning software treats as one. Level 1 is the accumulation question. Do you have enough? This is the question everyone obsesses over. The simulation answer, the Monte Carlo probability. Jamie, 85%. Green light. Most advisors stop here. Level 2 is the sequencing question. In what order do you pull from which accounts to minimize your effective tax rate and maximize your subsidy eligibility? This is the question almost nobody models until they're already retired and the damage is done. Jamie's original plan, terrible sequencing. Jamie's revised plan, almost perfect sequencing. Same assets, fundamentally different outcome. Level 3 is the behavioral architecture question. Will you actually make the adjustment? Will you reduce your 401k contribution to the match even though your employer's plan enrollment system defaults to maximum? Even though every financial article for 30 years has told you to maximize tax advantage space, even though it feels like you're leaving money on the table, this is where the real work happens. Because the brain experiences a reduction in 401k contribution as a loss, even when the math shows it's a gain. Research shows that the pain of losses exceeds the pleasure from gains, and this feeling can be amplified when money is involved. Knowing about loss aversion doesn't make you immune to it, but naming it explicitly, seeing it in the numbers, having a framework that makes the alternative decision feel systematic rather than arbitrary, that's how you override the default. This is why I think about retirement as primarily a psychology problem wearing a math costume. The math is solvable in a spreadsheet. The behavioral piece requires understanding why you'll resist the correct answer even after you understand it. Let me also give you a reality check on the 4% rule while I have you here, because it's directly relevant to an early retirement at 60. Early retirees face 40 to 50-year retirement horizons, which the 4% rule was not designed for. FIRE movement researchers often use 3 to 3.5% withdrawal rates for greater safety. Morningstar's State of Retirement Income report found that 3.9% is the highest safe starting withdrawal rate for new retirees. Assuming a 40% stock and 60% bond portfolio, a 30-year time horizon, and a 90% probability of not running out of money. Jamie's plan pulls roughly 4% of her total portfolio in year 1 of retirement. That's within range. But here's what makes her situation fundamentally different from the standard 4% model. She has a Social Security bridge coming at 67 that will permanently reduce the amount she needs to pull from the portfolio. The moment Social Security activates at $3,100 per month, her annual withdrawal from savings drops dramatically. That materially improves her portfolio survival odds over the long run. The 5 years from 60 to 67 are the hardest. Social Security is the cavalry. And the sequencing strategy ensures that when the cavalry arrives, her portfolio is still standing. One more thing I want to show you, the subplot twist, because it fundamentally changes how I think about this whole framework. Marcus, the guy from the beginning, after about 9 months of higher than expected premiums and a bigger than expected tax bill, he got bored. He went back to work part-time, consulting, 30 hours a week. And here's the irony. While 73% of workers say they plan to work for pay in retirement, just 30% of retirees report that they've actually done so. Marcus became one of the 30% not because he had to, but because the identity transition out of structured work was harder than the financial projection accounted for. He didn't need the money, or not much of it. He needed the structure. And this is the quiet truth about early retirement, that the financial math never captures. The number in your account doesn't determine whether retirement feels right. The design of your daily life does. And here's what's interesting about Marcus going back to work. Because he was earning some income from consulting, he actually was able to reduce his IRA distributions, keep his MAGI lower, and partially rescue the subsidy situation he'd walked into. He stumbled into a version of the income stacking strategy by accident. But the people who implement this deliberately, who build the brokerage account, who plan the IRA drains, who maintain the MAGI deliberately, they have this optionality built in from day one. They can work or not work in year 2 of retirement, and the financial math doesn't punish them either way. That is the invisible dividend of the right account structure. Optionality. The freedom to make decisions go back part-time, reduce spending, delay Social Security, pull slightly more in a good year and slightly less in a bad one, without any single decision blowing up the whole plan. The fully maxed one funnel strategy doesn't give you that, it gives you one lever. And when the environment changes, and it will, one lever is not enough. Now, let me give you the 3 practical takeaways, and I mean specific, non-obvious, calibrated to exactly this situation. First, before you finalize anything, calculate what your MAGI would look like in each year from age 60 to 65 if you only pulled from tax-deferred accounts. If that number exceeds $62,600, the 2026 ACA subsidy cliff for a single filer, you have a structural problem that redirecting 401k contributions to brokerage today can solve. The math has to run backward from retirement, not forward from current contributions. Most planners don't do this. Do it yourself or find someone who will. Second, when you retire, use the standard deduction as an annual IRA drain. The 2026 standard deduction for single filers is $16,100. Pull up to that number from your traditional IRA every year in retirement and owe essentially nothing in federal income tax on it. Don't wait until you need the money to start doing this. Start on day 1 of retirement. Every dollar you drain this way in a low-income year is a dollar that passes through the funnel cheaply, reduces your future required minimum distribution liability starting at 73, and doesn't contribute to a MAGI spike. Systematic, boring, effective. Third, reframe the brokerage account in your mind right now. Stop thinking of it as the place you put money after maxing the 401k. Start thinking of it as your ACA armor. The taxable brokerage, funded with after-tax dollars and invested in broad, low-cost index funds, generates long-term capital gains that in 2026 face 0% federal tax for single filers with taxable income up to $49,450. That's your income buffer. That's the account that keeps your MAGI in the subsidy zone while you wait for Medicare. Building it now by redirecting from the 401k to the brokerage is the single highest leverage financial decision available to you in the next 5 years. 3 levers: contribution rate, IRA drain amount, brokerage balance. Adjust them deliberately now, and the 5 years between 60 and 65 look fundamentally different. And I want to close by pointing out the absurdity of the default. You will never receive a letter from your 401k provider that says, "We notice your account is getting quite large. Have you considered contributing less?" That letter does not exist. The financial system's incentives point in one direction at all times: more contributions, more assets under management, more fees, more balance to report. The strategy in this video requires consciously choosing to do less, 401k, more brokerage, less complexity, more control. It runs against every piece of marketing you've ever received about retirement savings, and it works precisely because of that. Lazy investing built more fortune than crypto memes. The least interesting decision you can make, redirecting $22,000 per year from one account type to another, will save you more money in retirement than any market prediction you'll ever act on. The system doesn't want you to know that. You're welcome.